There was a time when Wall Street paid the highest price for boldness. Companies that promised rapid disruption, aggressive expansion, and explosive long-term growth often commanded premium valuations. Investors chased upside. Risk felt exciting. Volatility was tolerated as part of the journey. Today, something very different is happening. Predictability is trading at a premium on Wall Street. Stability, consistency, and visibility are being rewarded more than big promises. And that shift tells us something important about how investors are interpreting the current economic environment. At the heart of this change is uncertainty. Over the past several years, markets have been hit by rapid inflation, aggressive interest rate hikes, supply chain disruptions, geopolitical tensions, and shifting consumer behavior. Forecasts that once seemed reliable suddenly became fragile. Companies that issued confident projections often had to revise them months later. Investors adjusted their mindset. Instead of asking, "How fast can this company grow?" they began asking, "How reliable are its future cash flows?" When uncertainty rises, risk tolerance falls, and when risk tolerance falls, predictability becomes valuable. Interest rates play a major role in this dynamic. In a low-rate environment, future earnings are discounted less heavily, which makes long-term growth stories more attractive. Investors are willing to wait years for profits if borrowing costs are cheap and liquidity is abundant. But when interest rates rise, the math changes. Future cash flows are discounted more aggressively. Distant profits become less valuable in present terms. That forces investors to focus more on near-term earnings, stable margins, and consistent cash generation. Companies with steady revenue streams, recurring subscription models, and strong balance sheets suddenly look more appealing. Another factor is earnings volatility. In recent quarters, markets have reacted sharply to even small adjustments in forward guidance. A company can beat quarterly expectations but still see its stock fall if its outlook becomes less certain. That reaction highlights how sensitive Wall Street has become to unpredictability. Consistency builds trust. Trust supports valuation multiples. Margin durability is also under scrutiny. During inflationary periods, many businesses were able to pass higher costs onto customers. Investors are now questioning whether those margins can hold if demand weakens. Companies with clear pricing power and stable cost structures are rewarded because their earnings appear more defensible. In contrast, firms operating in highly cyclical or unpredictable sectors often trade at lower multiples, even if their growth rates are higher. Balance sheet strength reinforces this premium on predictability. Companies with manageable debt levels, long-term financing locked in at favorable rates, and strong liquidity buffers are perceived as safer. Investors view them as better positioned to withstand economic shocks. Leverage amplifies risk. Stability reduces it. Wall Street is also responding to broader geopolitical and policy uncertainty. Trade tensions, regulatory changes, and shifting industrial policies make forecasting more difficult. Companies heavily exposed to global supply chains or regulatory decisions face additional valuation pressure. Firms with diversified operations and transparent risk management strategies appear more predictable. That predictability translates into stronger investor confidence. The shift is visible across sectors. In technology, companies emphasizing disciplined spending and clear monetization pathways are often rewarded over those pursuing expansive but uncertain innovation bets. In consumer goods, brands with stable demand and recurring revenue models are valued more highly than trend-dependent businesses. Even within growth sectors like artificial intelligence, markets are distinguishing between hype and measurable revenue. Investors are rewarding companies that demonstrate practical applications and sustainable margins rather than purely visionary narratives. Psychology plays a role as well. After multiple market corrections and rapid shifts in sentiment, investors have become more cautious. Volatility fatigue changes behavior. Portfolio managers prioritize capital preservation alongside returns. Predictable companies fit better into that framework. This does not mean growth is unimportant. Growth still matters. But it must be supported by execution clarity and financial discipline. A company growing steadily at moderate rates with strong margins may receive a higher valuation than a faster-growing firm with uncertain profitability. The quality of growth now matters more than the speed of growth. Corporate leadership teams have noticed. Earnings calls emphasize stability, risk management, and operational efficiency. Companies highlight recurring revenue percentages, customer retention rates, and cost controls. Messaging has shifted from aggressive expansion to disciplined performance. Markets respond accordingly. Why predictability is trading at a premium on Wall Street ultimately comes down to confidence. Investors are navigating a world where macroeconomic signals can change quickly. They are pricing in the possibility of slower growth, tighter liquidity, and policy shifts. In that environment, companies that offer clear guidance, consistent execution, and resilient business models feel safer.